Are you a business owner looking to boost your cash flow and grow your business? Welcome to Surge Capital Funding, where we unlock the secrets of financial success. Today, we're diving into the world of merchant cash advances, a powerful tool for businesses just like yours. Stay tuned as we explore how you can leverage this financial strategy to fuel your business growth and navigate through its challenges. And don't forget to hit the subscribe button and ring the bell to get notified about our latest financial insights. Let's get started and transform your business finances today. All right, welcome to today's video, where we're going to dive into the world of merchant cash advances, often referred to as MCAs. Now, these financial instruments provide a lump sum of cash to businesses in exchange for a percentage of the credit card sales. Businesses such as restaurants and bars, liquor stores, gas stations, dry cleaners, auto repair shops, convenience stores, and many more. So today we'll explore how MCAs work, their benefits and drawbacks, documentation requirements, and the approval process. We'll also be using underwriting guidelines as a reference. So what is a merchant cash advance? A merchant cash advance is not a loan, but an advance based on the future credit card sales of a business. It provides immediate funding that businesses can use for a variety of needs like inventory purchases, equipment purchases, marketing, or to just stabilize the cash flow during slow periods. Unlike traditional bank loans, which have fixed repayments, MCA's repayments are made through daily or weekly remittances from the business's credit cards transactions. So how does MCAs work? Well, when a business receives a merchant cash advance or MCA, they agree to repay the advance plus a fee by allowing the lender to collect a percentage of the daily credit card sales until the advance is paid off in full. This amount and the terms of the repayment depends on the business's credit card sales and financial stability. Now, for example, we have MCA products that can fund your business from $2,000 all the way to $500,000, with terms and repayment factors adjusted according to the business credit card transactions, the business credit scores, your time in business, and the business average monthly revenue. The repayment terms includes factor rates, which is the total cost of the advance, and the remittance percentage, which is the portion of the daily credit card sales. And that's taken into effect the repayment amounts of the advance, which normally range about from 15 to 35% of the monthly amount, depending on the product tier and the business revenue. So let's talk about the offer and agreement. So if you're approved, your business is presented with an offer outlining the advance terms, now including the advance amounts, the factor rates, the repayment percentage, and other things. So also upon agreement, contracts are signed and the terms are finalized. And once everything is finalized, the next thing is funding. Once the agreement is signed, the funds are transferred into your business bank account within 4 to 72 hours. It's a very quick process. Now, as with any financial product, MCAs come with their own pros and cons. Okay, so let's talk about the pros. The first one is quick access to capital. One of the biggest advantages of MCAs is the speed of funding. Businesses can often get cash received into their business account within 1 to 3 days of applying, which is crucial for covering immediate expenses or capitalizing on timely opportunities. Also, there are no collateral requirements. Businesses can secure MCA loans without risking assets as collateral. Repayment terms are tied into the business's sales volume. So this means that repayment amounts are lower during slower periods, and also this helps manage business cash flow more effectively. High approval rates. Yes, MCAs have high approval rates. MCAs often have less stringent approval criteria compared to the traditional bank loans, making them more accessible to businesses with poor credit in shorter periods of being in business. All right, we've talked about the pros. Now, let's talk about the cons. Now, first of all, one of the major cons is going to be a higher cost of capital. MCAs can be more expensive than traditional bank loans due to the higher factor rates and fees. Overall cost of borrowing can be significantly higher, reflecting the lender's risk that they have involved in the transaction. Impact on cash flow. Now, since repayment is tied into the daily and weekly sales of your business, the business needs to ensure that they can manage their cash flow effectively with these regular deductions coming out of your account every single day or every single week, which can be substantial. Less regulation. The MCA industry is not as heavily regulated as traditional banking, so which can lead to less transparency and potential unfavorable terms for the borrower. Cycle of debt. Now, some businesses rely on excessive MCAs to manage cash flow, leading to a cycle of debt that can be difficult to break, especially if your company does not experience the expected growth in revenue. Now, even with the high approval rates of MCAs compared to traditional bank loans, merchant cash advances, they can be denied. And they're denied for several reasons that often relate to the financial health and stability of the business. Now, here are some common reasons why MCA applications are denied. First one, poor credit history. While MCAs often have less stringent credit requirements than traditional loans, a very low credit score by the borrower, usually a personal credit score around or under 500, can be a reason for denial. Lenders look at credit scores to gauge the financial responsibility of the borrower and the predicted future behavior. Insufficient sales volume. Now, MCAs are paid through a percentage of the future credit card sales. Now, if the business does not have consistent or sufficient volume credit card transactions, lenders may view the businesses as unable to repay the advance. Well, many MCA providers require businesses to have been in operations, to been in business for a period at least 6 months. And that's not bad. 6 months in business before they're eligible for an advance. Now, this criteria helps lenders assess the stability and the viability of the business. Industry type. Well, some industries are considered high risk than others, and businesses in these sectors may be denied the MCA. So, in industries often deemed as high risk include those with high failure rates, less legal restrictions, or significant revenue fluctuations. Here, existing business debt. If a business already has significant debt or has other cash advances, normally more than 4, 5, or the loans that is actually servicing, lenders may be considered over leveraged and therefore a higher risk for additional financing. So that may be a reason to get denied. This is a bad one here. Negative bank balances. Negative bank account balances. Regular overdrafts or negative balances in a business account can signal financial instability to the lenders, leading to a denial of the MCA application altogether. More than 5 negative days per month is normally the threshold. Legal and compliance issues. Now, legal problems such as unresolved judgments, liens, or ongoing lawsuits can also lead to denial. Lenders will typically conduct background checks to uncover any legal and compliance issues. Understanding these factors can help business assess their likelihood of obtaining a MCA loan and take steps to improve their eligibility before applying. So let's talk about the application process for these MCA loans. Now, business owners usually start by filling out a one-page application. The basic information on the application is the name, industry, the monthly credit card sales, the total monthly amount that they're getting in as far as revenue. Also, they're going to ask for business duration information, financial information, also ownership details on that application. And once again, this information will be submitted on this one-page application. Very simple application. The required documents for an MCA application will include bank statements. Usually the last 3 to 6 months of statements are required to assess your business cash flow and financial health. Credit card processing statements. We need your recent credit card processing statements. Also to verify the volume of credit card sales, typically covering the last 3 to 6 months. We will verify your business ownership and legal structure using documents such as maybe a business license, partnership agreement, or articles of incorporation. Also, we need your driver's license, passport, or a government issued ID of the business owners to confirm identity and to conduct a background check. We're going to need a voided business check for the account where the money will be advanced, will be deposited to, and for which the repayment will be withdrawn from. Also, we may request your tax returns or your other financials as far as the profit and loss. And that's if you're looking for a better rates, more money. But a lot of times those 2 documents, the financial statements, as far as your P&Ls, won't be required, and your tax returns won't be required unless you're looking for larger amounts of money. So once all the documentation is received and the application is looked at and reviewed, we go into the review and approval process. The application is then submitted to the actual lender, who reviews the submitted application and documentation to make a final decision. This process can be fairly quick. Some lenders offer decisions between a few hours or just a day. So very quick process. So the key takeaway here is that MCAs offer a flexible funding solution, especially for businesses with fluctuating sales. However, the higher cost and the impact on the cash flow requires careful consideration. Companies should evaluate their financial stability, understand the repayment structure, and ensure the MCA aligns with their long-term financial goals. So in conclusion, merchant cash advances can be a vital tool for businesses in need of quick and flexible funding. By understanding the nuisance of MCAs, companies can make informed decisions that support their financial health and growth. Remember, the right financial choice depends on your business' unique needs and circumstances. So if you found this video helpful, please like, share, and subscribe to our channel at Surge Capital Funding for more insightful financial guides and tips. Your success is our mission, and we're here to help you achieve it. Got questions or need more advice? Drop us a comment below, and let's keep the conversation going. Until next time, keep pushing the boundaries and elevate your business to new heights. And follow us on social media and join our community of thriving entrepreneurs. See you next time.